beloved seekers of prosperity, respected viewers on the path to financial wisdom. There's a question that's been haunting investors for generations, a question whispered in boardrooms and shouted on trading floors, a question that separates those who build empires from those who merely survive. Where do I put my money next? But here's what most people miss, what they fundamentally misunderstand about that question. The answer isn't about predicting the future. It's about understanding human nature. It's about seeing what everyone else is looking at, but comprehending what they cannot see. And right now, America, in this very moment, there's an opportunity so profound, so misunderstood, so overlooked by the masses chasing shiny objects, that those who recognize it will be telling their grandchildren about this decade for the rest of their lives. Let me take you back to a moment that changed everything for me. It was 1974. America was in chaos. Watergate, oil crisis, inflation at 11%, stock market down 45% from its peak. Everyone was terrified. Everyone was selling. Everyone believed the American dream was dead. I remember sitting in a small office, looking at the financial statements of a company, a boring company, a company that made candy bars and chewing gum. The numbers were beautiful, strong cash flow, minimal debt, dominant market position, and the stock was trading for less than the company would be worth if you just liquidated it and sold off the pieces. People were giving away dollars for 50 cents because they were afraid. My hands were shaking, not from fear, but from excitement, because I understood something that the panicking masses did not. Fear creates the greatest opportunities. When everyone is running away from something, that's exactly when you should be running toward it, not recklessly, not blindly, but with clear eyes and a steady hand. That investment, that single decision made in a moment of national despair, returned more than 10% over the following decades. But here's what matters. It wasn't genius that led to that return. It wasn't luck. It wasn't insider information. It was the willingness to invest when it felt terrifying to do so. It was the ability to see value when everyone else saw only danger. It was understanding that the best investments, the truly life-changing investments, they never feel comfortable when you make them. They feel risky. They feel contrarian. They feel lonely. Because you're buying when everyone else is selling. You're being greedy when everyone else is fearful. So let me tell you about America today, right now, this moment, 2025. I'm going to share something with you that might make you uncomfortable. The best investment opportunities in America, right now, they're not where everyone is looking. They're not in artificial intelligence stocks that are priced for perfection. They're not in cryptocurrency that promises to make you rich overnight. They're not in the hot IPO that your coworker won't stop talking about. The real opportunities, the ones that will create lasting wealth, they're hiding in plain sight, in boring places, in unsexy sectors, in businesses that have been ignored, overlooked, dismissed by the crowd chasing excitement. Let me tell you about 3 categories of investment, 3 areas in America today where patient, thoughtful capital can compound into generational wealth. And I'm going to start with the one that makes people yawn. Category 1, the forgotten dividend aristocrats. There are companies in America, companies that have increased their dividends every single year for 25 years or more. Think about that. Through the dot-com crash, through 9/11, through the 2008 financial crisis, through COVID, they kept raising their dividends. These aren't exciting companies. They don't have charismatic CEOs doing podcasts. They don't have products that go viral on social media. They make things like industrial adhesives, medical supplies, cleaning products, food ingredients, boring, reliable, essential. And right now, many of these companies are trading at valuations we haven't seen in a decade. Why? Because everyone is chasing the new thing, the exciting thing, the thing that might 10x in a year. They've forgotten about the companies that 10x over decades, while paying you dividends the entire time. Let me tell you about a man named Frank. Frank was a factory worker in Ohio, made about $42,000 a year his entire working life. In 1985, when he was 30 years old, Frank started buying shares of 3 companies: Procter & Gamble, Johnson & Johnson, Coca-Cola, boring companies. Companies his friends laughed at him for buying. Why are you investing in soap and soda? They'd say, that's not where the money is. Frank ignored them. He invested $200 a month, every month, for 35 years. He reinvested every dividend, never sold a share. When Frank retired in 2020 at age 65, his portfolio was worth $1.4 million, from $200 a month buying boring dividend stocks. But here's the beautiful part. Those stocks were now generating $52,000 a year in dividend income, more than he ever made working. Frank didn't need to sell a single share. He lived off the dividends, and the principal kept growing. His children would inherit over $2 million. All because Frank understood something profound: boring wins. Right now, today, there are dozens of companies like the ones Frank bought. Companies with 30, 40, 50-year track records of dividend growth. Companies trading at price-to-earnings ratios of 12 or 13 when the market average is over 20. Companies yielding 4% or 5% in dividends when treasury bonds yield less. Companies that are more profitable today than they've ever been. But nobody wants them because they're not innovative. This is opportunity. This is where your next profitable investment lies. Not in the headlines, not in the hype, in the boring, reliable, cash-generating businesses that will still be here in 30 years. To now, let me address what you're thinking. But what about growth? What about technology? What about missing out on the next big thing? Valid questions. So let me tell you about Category 2. As Category 2. The infrastructure revolution. America is about to undergo the largest infrastructure transformation in a century. Not might, will. The electrical grid is being rebuilt for renewable energy and electric vehicles. Water systems that haven't been updated since the 1950s are being replaced. Broadband is being extended to rural America. Bridges, roads, ports, all being modernized. We're talking about trillions of dollars, plural, being invested over the next 2 decades. And here's what most investors miss. The money isn't made by investing in the projects. The money is made by investing in the companies that build the projects. Let me tell you about a conversation I had with a young investor last year. He was excited about electric vehicles, convinced that was the future. "I'm going to invest in EV companies," he told me. "That's where the growth is." I asked him a simple question. Who makes more money? The company that makes the cars, or the companies that make the copper wiring, the lithium batteries, the charging infrastructure, the electrical components? He paused. The car company gets all the attention, I continued, but it operates on razor-thin margins, massive competition, constantly having to innovate or die. But the company that supplies critical components, they sell to everyone. They have pricing power. They make consistent profits regardless of which car company wins. During the gold rush, I said, the people who got rich weren't the miners. They were the ones selling pickaxes and shovels. His eyes widened. Right now in America, there are companies positioned perfectly for this infrastructure boom. Companies that make electrical transformers, copper wire, concrete, steel, industrial equipment. Companies with order backlogs stretching years into the future. Companies trading at reasonable valuations because, again, they're boring. Nobody wants to tell their friends they invested in a transformer manufacturer. But that transformer manufacturer might triple your money over the next decade, while paying you dividends the whole time. This is intelligent investing. This is how wealth is actually built, not by chasing stories, but by following the money. Tours. Category 3, the housing crisis solution. Let me tell you something that's going to sound controversial. America has a housing crisis, not because homes are too expensive, though they are, but because we haven't built enough homes for 2 decades. We're short about 4 million housing units right now. 4 million. And every year, more millennials and Gen Z are reaching the age where they want to buy homes. Every year, immigration adds to the demand. Every year, the shortage gets worse. This isn't a problem that gets solved quickly. This is a decade-long opportunity. Most people think, I should buy real estate, and maybe you should. Real estate has created more millionaires than any other asset class in history. But here's what I want you to consider. Direct real estate investing, buying properties, managing tenants, dealing with repairs, it's a job, not an investment. It can be lucrative, but it's active. It requires your time, your attention, your energy. But what if you could invest in the housing shortage without being a landlord? What if you could own the companies that benefit from housing without fixing toilets at 2 a.m.? Let me tell you about Sarah. Sarah wanted to invest in real estate. She had $100,000 saved. She looked at buying a rental property. In her market, that would get her a small condo, maybe cash flow $300 a month after expenses if she was lucky. Instead, Sarah did something different. She invested $50 in a diversified portfolio of home builder stocks. She invested $30 in a real estate investment trust specializing in single-family rentals. She invested $20 in companies that make building materials, lumber, roofing, flooring. Over the next 5 years, the home builders doubled as demand for new construction surged. The ride appreciated 60% while paying her consistent dividends. The building materials companies tripled as housing starts increased. Her $100,000 became $280,000. No tenants, no repairs, no 2 a.m. phone calls. Just ownership in businesses solving America's housing shortage. This is what I mean by intelligent investing. You don't have to do the hard work yourself. You can own the businesses that do the hard work and collect the profits. Sarah understood this. She invested in the problem, not in doing the work to solve it, and she was rewarded handsomely. Now, here's what ties all three categories together: the dividend aristocrats, the infrastructure plays, the housing shortage solution. They all share one critical characteristic. They're solving real problems, not theoretical problems, not maybe someday. Problems, real problems, today, that aren't going away. People need reliable products. That's what dividend aristocrats provide. America needs infrastructure. That's what those boring industrial companies build. America needs housing. That's what home builders and related companies deliver. When you invest in companies solving real, persistent problems, you don't need to predict the future. You just need to be patient. Let me tell you about the biggest mistake I see investors make. They confuse investing with speculation. Speculation is betting on price movements. It's trying to predict what other people will think tomorrow about something they're thinking about today. It's exhausting. It's stressful. And over time, it loses money. Investing is different. Investing is buying ownership in productive assets that generate cash flow. It's buying a piece of a business that serves customers, earns profits, and returns capital to shareholders. It's boring. It's patient. And over time, it creates wealth. I've watched this play out for over 6 decades. The speculators, they have exciting stories. They make 300% in a year, then lose 80% the next year. They're always chasing, always anxious, always looking for the next big score. And 20 years later, they're still hoping to get rich. The investors, they're quiet, steady, boring. They buy good businesses at fair prices. They collect dividends. They reinvest. They wait. And 20 years later, they're wealthy. Not because they were smarter, not because they worked harder, because they understood the game they were playing. You know what separates a good investment from a great investment? It's not the size of the potential return. It's not how exciting the story sounds. It's not even how innovative the company is. The difference, the real difference, is something most investors never think about. It's the margin of safety. Let me tell you about 2 investors I knew. Both had $50 to invest in 1999. The first investor, we'll call him Tom, bought shares of a hot internet company. The company had amazing growth, triple-digit revenue increases, a charismatic CEO. Everyone was talking about it. The stock was trading at 200 times earnings. Tom didn't care. It's the future, he said. Traditional valuation metrics don't apply to technology. The second investor, we'll call her Linda, bought shares of a regional bank, boring business, steady profits, trading at 8 times earnings, dividend yield of 4%. Tom laughed at Linda's choice. Banks. That's old economy thinking. You're going to miss the revolution. 2 years later, Tom's internet company had gone bankrupt. His 50,000 was worth €0. Linda's bank had increased its dividend twice. Her investment was worth a 68,000, and she'd collected 4,000 in dividends. What was the difference? Tom paid an expensive price for a dream. Linda paid a cheap price for a business. When the dream evaporated, Tom lost everything. When the economy struggled, Linda's bank had enough margin of safety, enough intrinsic value, to survive and thrive. This is what I need you to understand about profitable investing. Price is what you pay. Value is what you get. And the difference between the two, that's your margin of safety. That's your protection against being wrong. That's the cushion that lets you sleep at night. So when I talk about the next profitable investment in America, when I tell you about dividend aristocrats, infrastructure companies, housing-related businesses, I'm not just telling you what to buy. I'm telling you what to look for, the characteristics that separate wealth building investments from wealth destroying speculation. Here's characteristic 1, pricing power. Let me ask you a question. If a company raises its prices by 5%, do its customers have any choice but to pay? If the answer is yes, if the company has pricing power, that's a valuable business. If the answer is no, if customers can easily switch to a competitor, that's a commodity business. And commodity businesses, they're terrible investments. Think about Coca-Cola. If they raise the price of a Coke from 2,002 points and $1, do you stop drinking Coke? Maybe you grumble. Maybe you notice. But you probably still buy it. That's pricing power. Now think about a generic manufacturer of USB cables. If they raise their price by 5%, the customers instantly switch to the hundreds of identical competitors. No pricing power. One company can protect its margins during inflation. The other company gets squeezed until profits disappear. Right now in America, there are companies with incredible pricing power trading at reasonable prices. Companies that make specialized industrial equipment that customers depend on. Companies that own brands people trust and won't substitute. Companies that provide services that are essential, not optional. These companies, when inflation comes, and it always comes eventually, they raise prices. They maintain margins. They protect shareholder value. The commodity businesses, they suffer. They cut dividends. They destroy wealth. This is why pricing power matters more than almost anything else. Let me tell you about a mistake I almost made years ago. I was looking at 2 companies in the same industry. Company A had higher growth, more exciting products, a younger management team. Company B was slower growing, boring products, management in their 60s. On paper, Company A looked better. But then I asked the critical question, which company could raise prices without losing customers? The answer was Company B. They had relationships going back decades. Their customers depended on them. Switching costs were high. Company A was in a competitive race to the bottom on price. I invested in Company B over the next 20 years. Company B increased in value by 800%. Company A went bankrupt. Characteristic 2, capital efficiency. Here's something most investors never consider. How much capital does a company need to invest just to maintain its current business? Some businesses, they're like hamsters on a wheel. They have to keep spending, keep investing, keep pouring money in just to stay in the same place. Other businesses, they generate cash, and they can either return it to shareholders or reinvest it in growth. The second type, those are the investments you want. 2, let me give you an example. An airline needs to constantly buy new planes. Billions of dollars in capital expenditure just to replace aging fleets. A software company, once the software is built, the marginal cost of serving another customer is nearly zero. Which one would you rather own? The business that consumes capital, or the business that generates it? Right now in America, there are incredibly capital-efficient businesses that nobody's paying attention to. Insurance companies that collect premiums and invest the float. Asset management companies that earn fees without needing physical infrastructure. Specialized manufacturers with loyal customer bases and minimal reinvestment needs. These businesses, they generate excess cash, and that excess cash, it gets returned to you through dividends and buybacks, or it gets reinvested at high returns, compounding your wealth. This is how you get rich slowly, then suddenly. I knew a man who spent 40 years investing in capital-intensive businesses. Steel mills, airlines, automobile manufacturers. These businesses had to constantly invest billions just to stay competitive. Every dollar they earned went right back into the business. Shareholders got scraps. He worked hard. He researched thoroughly. He picked the best companies in each sector. And over 40 years, he barely beat inflation. Then I knew another man who invested in capital-light businesses. Payment processors, credit rating agencies, tax preparation software. These businesses generated enormous cash flows with minimal reinvestment. They returned most of their profits to shareholders. Over 40 years, he became extraordinarily wealthy. Same time period, same effort, different understanding of capital efficiency. Q2 characteristic 3, management quality. Let me tell you something controversial. Most CEOs are not worth their compensation. They're paid like they're irreplaceable geniuses when they're often just competent administrators. But occasionally, very occasionally, You find management teams that are special, and when you find them, you hold on tight. What makes management special? It's not charisma. The best managers are often boring. It's not vision. Vision without execution is just daydreaming. What makes management special is three things. 1, they allocate capital intelligently. 2, they're honest with shareholders. 3, they think like owners, not employees. Capital allocation is the most important job of any CEO. The company generates cash. What do they do with it? Do they waste it on empire building acquisitions? Do they invest in low return projects just to show growth? Do they pay themselves excessive bonuses? Or do they invest in high return opportunities, return excess cash to shareholders, and make decisions that compound value over decades? The difference in outcomes over 20 or 30 years is staggering. Let me tell you about 2 companies I watched for decades. Both were in similar businesses. Both were profitable. Company A had a CEO who loved making acquisitions. Every few years, a big splashy purchase, press releases, analyst calls touting synergies. Most of those acquisitions destroyed value, but the CEO got bigger, more powerful, more important. Company B had a CEO who was pathologically disciplined about capital allocation. They rarely made acquisitions. When they did, they were small, strategic, accretive. Most of their excess cash went to dividends and buybacks. Over 30 years, Company A's stock barely moved. All that activity, all those acquisitions, no value created. Company B's stock increased 30-fold. Boring, steady compounding. The difference, capital allocation to and honesty, this matters more than people realize. When things go wrong, and they always do eventually, do you want a CEO who's honest about the problems? Or do you want a CEO who spins, deflects, blames external factors? Because dishonest management, they'll destroy your investment before you even realize there's a problem. 2, I remember a company I invested in decades ago. They had a quarterly earnings call where the numbers missed expectations. The CEO could have made excuses, could have blamed the economy, the competition, bad luck. Instead, he said something I never forgot. We made mistakes. Specifically, we expanded too quickly into a market we didn't understand. It was my decision. It was wrong. We're correcting it. Here's how. That honesty, that ownership, told me everything I needed to know. I held that stock for 20 years. It was one of my best investments. It is characteristic 4, competitive advantage. Here's a question I ask about every potential investment. What would it take for a competitor to replicate this business? If the answer is not much, I'm not interested. But if the answer is decades and billions of dollars, and even then they might fail, now we're talking. 2, competitive advantages come in many forms. Brand loyalty that takes generations to build. Network effects where each customer makes the service more valuable to others. Regulatory moats that make new competition nearly impossible. Scale advantages where being biggest makes you lowest cost. Patents and intellectual property that can't be easily duplicated. When you find a business with real competitive advantages, you're not just buying a company. You're buying a franchise, a toll booth, a stream of profits that competitors can't easily disrupt. Let me tell you about the greatest investment I ever made, not because of the return, though the return was extraordinary, but because of what it taught me about competitive advantages. It was a company with a simple business model. They provided a service that businesses absolutely needed. But here's the key. Once a business was using their service, switching to a competitor was incredibly painful. It would require retraining employees, changing processes, taking on integration risk. Most businesses, they just kept using this company year after year after year. And every year, the company would raise prices by 3 or 4 or 5%, and customers would grumble, but they'd pay. Because switching wasn't worth the hassle. That's a competitive moat. That's what you want to own. To over 30 years, that company's revenue grew 12% annually, not because they were innovating constantly, not because they had visionary leadership, but because they'd built something competitors couldn't easily replicate, and they had pricing power that let them capture the value they created. My investment multiplied 50 times. From understanding competitive advantages to now, let me tell you about the trap I mentioned, the biggest mistake catching investors right now. It's subtle, it's seductive, and it's destroying wealth at a scale we haven't seen since the late 1990s. The trap is this. Investors are paying growth prices for average businesses. They're valuing companies based on what they might become, not what they are. They're buying dreams, not cash flows. I see it everywhere right now. Technology companies with no profits trading at 20 times revenue. Electric vehicle companies that lose money on every car, valued like they're the next automotive giants. Companies in emerging industries with unproven business models, priced for perfection. And investors, as smart investors, people who should know better, they're buying these companies because they're afraid of missing out, because their friends are making money, because the story sounds compelling. Let me tell you what happens with these investments. The story is always seductive. This company is going to disrupt a $1 trillion industry. They're growing revenue at 100% per year. Traditional valuation metrics don't apply. And maybe the story comes true. Maybe this company becomes the next Amazon or Apple. But probably, far more probably, the company faces more competition than expected. The economics of the business prove worse than projected. The market they're targeting takes longer to develop. And suddenly, that stock trading at 20 times revenue, it's worth a fraction of what you paid. I've seen this movie before. I saw it in 1999 with the dot-com bubble. I saw it in 2007 with financial engineering. I'm seeing it again now in pockets of the market. And the ending is always the same. The speculators lose everything. The investors, the ones who paid reasonable prices for real businesses, they survive, they compound, they build wealth. Let me be very clear. I'm not saying don't invest in growth companies. I'm not saying technology is a bad investment. I'm saying be honest about what you're buying. If you're paying 50 times earnings for a company, you're betting that everything goes right. That's not investing. That's speculation. If you're paying 12 times earnings for a company with steady profits and a solid dividend, you can afford to be wrong. You have a margin of safety. That's investing. And right now, today in America, there's an enormous valuation gap. The popular stocks, the ones everyone talks about, are priced for perfection. The unpopular stocks, the boring dividend payers, the industrial companies, the housing-related businesses, they're priced for pessimism. This gap, this disparity, it's opportunity, not for traders trying to flip stocks in 6 months, but for investors willing to wait 5 or 10 years. Let me tell you about the power of reversion to the mean. When stocks are overpriced, they tend to underperform over the next decade. When stocks are underpriced, they tend to outperform. This isn't opinion. This is mathematics backed by a century of data. Right now, the popular stocks are extremely overpriced. The unpopular stocks, in many cases, are reasonably priced or even cheap. Where do you think the better returns will come from over the next 10 years? I know the answer. I've lived through enough cycles to know how this story ends. The excitement fades, the valuations compress, the popular stocks disappoint, and the boring stocks, the ones nobody wanted, they quietly deliver double-digit returns year after year after year. This has happened in every cycle. It's happening again. The only question is, will you have the patience to wait for it? Let me share one more story before we move to part 3. There was a young investor, eager, intelligent, ambitious, who came to me in 2020. The market had just crashed because of COVID. Stocks were down 35%. He was terrified. Should I sell? He asked. Should I wait for things to stabilize? I asked him a simple question. Do you believe that in 10 years businesses will be serving customers, earning profits, and creating value? He thought about it. Yes, he said. Then why would you sell ownership in those businesses just because prices dropped? He didn't have an answer. The question isn't whether to invest, I told him. The question is what to invest in. Buy the companies that will definitely be here in 10 years. The ones solving real problems. The ones with pricing power and competitive advantages. Don't try to predict when the recovery will happen. Just own quality and wait. He followed that advice. He bought Dividend Aristocrats trading at their lowest valuations in years. He bought infrastructure companies positioned for the coming investment boom. He bought home builders when everyone thought real estate was dead. By 2024, his portfolio had more than doubled. Not because he timed the market perfectly. Not because he picked the hottest stocks. Because he invested in quality at reasonable prices, and he waited. That's the secret. That's always been the secret. There's a moment that comes to every investor, a quiet moment, usually late at night when you can't sleep. When you look at your portfolio, at the decisions you've made, at the money you've entrusted to businesses run by people you've never met, and you ask yourself a simple question: am I doing this right? I've had that moment, more times than I can count. And here's what I've learned. The answer to that question doesn't come from your returns last quarter. It doesn't come from comparing yourself to the market. It doesn't come from what financial media tells you. The answer comes from whether you can articulate, clearly and simply, why you own what you own. If you can't explain it, if you can't defend it with logic and evidence, you shouldn't own it. Let me give you a framework, a way of thinking that's guided me through more than 6 decades of investing. I call it the 5 questions. Before I invest a single dollar in any company, I must be able to answer these 5 questions with confidence. If I can't, I walk away, no matter how tempting the opportunity seems. Question 1, do I understand this business? Not do I understand the industry. Not do I understand the product category. Do I understand this specific business? How it makes money, who its customers are, why they buy. What could go wrong? Let me tell you about a mistake I almost made. It was the late 1990s. Everyone was investing in technology companies. There was a company, I'll leave it nameless, that was growing explosively. Revenue up 200% year over year. The analysts loved it. The media couldn't stop talking about it. My friends were buying it. They were making money. They kept asking me, why aren't you buying? I looked at the business model. I read the annual report 3 times. And I realized I didn't understand how they made money. The revenue was growing, but where did it come from? Who was paying them? Why? Would they keep paying? I couldn't answer those questions. So I didn't invest. The stock went up another 50% after that. My friends teased me. Then the company collapsed. It turned out the revenue was largely fictitious. Accounting fraud. The stock went to 0. My friends lost everything. I lost nothing because I followed my rule. If I don't understand it, I don't invest in it. Right now in America, there are businesses I don't understand. Cryptocurrency platforms, some biotech companies. Certain software as a service models. Maybe they're great investments. Maybe they'll make fortunes for the people who understand them. But I don't understand them. Not really. Not deeply enough to bet my money on them. So I stay away. And I sleep well at night. Because my portfolio, it's filled with businesses I understand completely. I understand how insurance companies make money. I understand how consumer staples companies earn profits. I understand how industrial manufacturers serve their customers. These businesses, they're not mysterious. They're not complex. And that's exactly why I own them. Question 2, does this business have a durable competitive advantage? I talked about this earlier. But it's so important that it deserves its own question. Because here's the reality. Most businesses don't have competitive advantages. They exist in competitive markets where any profit above normal returns attracts new competitors, who drive those profits down. These businesses, they're trade mills. You run hard just to stay in place. But occasionally, rarely, you find a business with a true moat, something that protects it from competition, something that lets it earn above average returns year after year after year. Those businesses, those are the ones worth owning. 2, how do you identify a moat? Here's a simple test. Imagine a competitor with unlimited capital enters this market. Can they replicate this business? If the answer is yes, there's no moat. If the answer is would take decades, and even then they might fail, there's a moat. Let me give you examples. Could a competitor replicate Coca-Cola? They could make a cola drink. Easy. But could they replicate the brand recognition, the emotional connection, the distribution network, the shelf space deals built over 130 years? No, they couldn't. That's a moat. Could a competitor replicate Amazon's e-commerce business? They could build a website. They could warehouse products. But could they replicate the logistics network, the Prime membership base, the AWS infrastructure, the data on customer behavior? Not easily. Not quickly. Maybe not ever. That's a moat. To right now in America, there are dozens of companies with real moats trading at reasonable prices. Credit card networks with billions of cardholders that took decades to build. Industrial companies with specialized products that customers depend on. Healthcare companies with regulatory approvals that take years and hundreds of millions to obtain. These companies, they're not exciting, but they're durable. And durability, over decades, beats excitement every single time. So question 3 is management allocating capital intelligently. I talked about this too. But let me go deeper, because this is where most investors get it wrong. They focus on revenue growth, on market share, on exciting new products. But they ignore the most important question. What is management doing with the cash the business generates? Here's what I look for. When the business generates excess cash beyond what it needs to maintain and grow, does management return it to shareholders through dividends and buybacks? Or do they waste it on empire, building acquisitions and vanity projects? Do they invest in high return opportunities within the business? Or do they chase low return growth just to show revenue increases? Do they maintain a fortress balance sheet with minimal debt? Or do they leverage up the business to juice short-term returns? The answers to these questions, they determine your long-term returns. Let me tell you about 2 CEOs I studied. CEO who loved acquisitions. Every year a new purchase. Always strategic, according to the press releases. His company's revenue grew consistently. Analysts praised his vision, but the return on invested capital declining every year because he was deploying capital at lower and lower returns. He was building an empire, but he wasn't building value. COB was the opposite. Boring, focused. His company rarely made acquisitions. Instead, they invested in improving their core business. They returned excess cash to shareholders. Revenue growth was slower. The analysts were less impressed, but the return on invested capital, consistently high, often increasing over 20 years. CEO's stock went up 200%. Sounds good. COB's stock went up 400%, 7 times more. Same industry, same time period. The difference, capital allocation. So when you're evaluating your next investment in America, don't just look at the business model. Look at who's running it. Read the annual letters to shareholders. Are they honest? Do they think long-term? Look at their track record of capital allocation. Do they create value or destroy it? Look at management compensation. Are they paid like owners or like employees? These details, they matter enormously over time. Question 4, am I paying a reasonable price? This is where most investors fail. They find a great business, they fall in love with it, and they pay any price to own it. That's not investing, that's speculation. Here's the truth. A great business at the wrong price is a bad investment. A good business at a great price is often a better investment. Price matters. Always. So how do you know if you're paying a reasonable price? I look at several metrics. The price to earnings ratio. Am I paying 10 times earnings, 50 times? The dividend yield. What's my cash return just from dividends? The price to book ratio. Am I paying a significant premium to the company's asset value? The free cash flow yield. How much cash does this business generate relative to my purchase price? Good, but here's what's most important. I compare those metrics to the company's history. If a company normally trades at 15 times earnings, and it's currently at 10 times, that's interesting. Something might be wrong, or it might be an opportunity. If that same company is trading at 30 times earnings, I don't care how great the business is. I'm not paying that price, because eventually always valuations revert to the mean. Let me tell you about a lesson I learned the hard way. I found a wonderful business. Everything was perfect, competitive advantages, great management, growing market. The only problem, the stock was trading at 40 times earnings, but I convinced myself it was worth it. This is a special company, I thought. I bought it. For the next 5 years, the business performed exactly as I expected. Earnings grew 12% per year. Everything I predicted came true. But the stock, it barely moved. Because the valuation compressed from 40 times earnings to 20 times earnings. The business doubled its earnings. The stock went nowhere. I had been right about the business, but wrong about the price. This is what you must understand. Your returns come from 2 sources. The growth of the underlying business, and the change in what people are willing to pay for that business. When you buy at a high valuation, you're betting that people will be willing to pay even more in the future. That's dangerous. When you buy at a reasonable valuation, the business growth alone can generate good returns. That's investing. Right now, today, in America. The popular stocks are trading at stretched valuations. The unpopular stocks, the boring dividend payers, the industrial companies, many are trading at or below their historical averages. Where would you rather invest? In the stocks where everyone's already optimistic, or in the stocks where expectations are low and any good news is a positive surprise? I know my answer. At question 5, can I hold this investment for 10 years? This is the ultimate question. If you can't imagine owning this stock for a decade, you shouldn't own it for 10 minutes. Because here's what happens over 10 years. The market will crash multiple times. Your stock will drop 30%, 40%, maybe 50%. There will be quarters where the company misses earnings. There will be years where the business struggles. Analysts will downgrade it. Media will question it. And in those moments, you'll be tempted to sell. The only thing that will keep you from selling is the deep conviction that comes from understanding the business, from knowing it has competitive advantages, from trusting management, from believing that the price you paid provides a margin of safety. 2, I've held some stocks for 40 years, not because I'm stubborn, not because I'm lazy, because I bought businesses so good at prices so reasonable that selling never made sense. The businesses kept growing. The dividends kept increasing. The competitive advantages remained intact. Why would I sell? To buy what? Something I understand less, something more expensive, something with less certainty. 2, when you find a business that meets all 5 criteria, when you understand it deeply, when it has a competitive moat, when management allocates capital wisely, when you're paying a reasonable price, when you can imagine holding it for a decade or more, that's when you invest, not before. Now let me give you a practical approach to applying this framework. Start with a watch list. Write down 20 or 30 companies you're interested in, companies and industries you understand, companies you've heard of, companies whose products you use. Then one by one work through the 5 questions. Most companies you'll eliminate quickly. I don't really understand this business. Cross it off. This company has no competitive advantage. Cross it off. Management has a terrible track record. Cross it off. The valuation is absurd. Cross it off. 2, by the time you're done, you might have 3 or 4 companies left. Companies that pass all 5 tests. Those companies, those are your investment opportunities. Now you wait, you watch them. You monitor the price. And when the market gives you an opportunity, when fear drives the price down, when nobody wants to buy, that's when you act. Let me tell you what this looks like in practice. I have a list of about 40 companies I follow closely. Wonderful businesses, all of them. But most of the time, they're too expensive. So I wait. I read their quarterly reports. I track their metrics. I stay informed. And maybe once every year or 2, one of them becomes attractively priced. A market crash, industry headwinds, a temporary problem. And suddenly, a business I'd love to own is trading at a price I'm willing to pay. That's when I buy. This approach, it's not exciting. You're not constantly trading. You're not chasing hot tips. You're not trying to beat the market every quarter. You're simply waiting patiently for the right opportunity. And when it comes, you act decisively. This is how wealth is actually built, not through brilliance, not through activity, through patience, through discipline, through waiting for the perfect pitch. Let me share the one principle, the most important principle, that makes long-term success nearly inevitable. It's so simple it sounds stupid, but it's also so powerful that if you follow it, you'll almost certainly build wealth. Here it is: only invest in businesses you'd be happy to own if the stock market closed for 10 years. Think about that. If you couldn't check the price, if you couldn't sell, if you were just an owner collecting your dividends and watching the business operate, would you be happy with this investment? If the answer is yes, you've found something special. If the answer is no, if you're only holding it because you think the price will go up, you're speculating, not investing. To this principle, it eliminates so many mistakes. It keeps you from chasing momentum. It keeps you from buying things you don't understand. It keeps you focused on business quality, not stock prices. I've followed this principle for 6 decades, and it saved me from more mistakes than I can count. Every time I'm tempted by a hot stock, every time I consider buying something trendy, I ask myself, would I want to own this if I couldn't sell it for 10 years? Usually the answer is no, and I walk away. Patusa, let me bring this full circle. Your next profitable investment in America. It's not about finding the next big thing. It's not about predicting the future. It's not about timing the market or chasing returns. It's about finding businesses that pass the 5 questions. Businesses you understand. Businesses with competitive advantages. Businesses with excellent management. Businesses trading at reasonable prices. Businesses you'd be happy owning for decades. Those businesses exist today. In boring industries that nobody's excited about. In dividend aristocrats that have been ignored. In infrastructure companies positioned for the coming boom. In housing-related businesses solving real problems. They're not hiding. They're right there in plain sight. The question is, do you have the patience to find them? Do you have the discipline to wait for the right price? Do you have the conviction to hold them when markets panic? Because that's what separates investors who build wealth from those who just stay busy. The busy investors, they're always doing something, buying, selling, trading, chasing. And 20 years later, they have little to show for it. The patient investors, they're doing very little. Waiting, watching, acting only when opportunity is obvious. And 20 years later, they're wealthy,